Welcome to the Small Business Tax Savings Podcast, your weekly dose of accounting and tax tips specific to small business owners. You will be on your way to growing your business and paying the least amount in taxes as legally possible. Here's your host, Mike Jesowshek, CPA.
Hello and welcome back to another episode. Today's topic is passive income. How is my income taxed? And this is actually our third episode that we're doing on this mini series that we're doing called How is my income taxed? And really the reason it started is understanding how different types of income are taxed can be confusing. And it's something that we see pop up all the time in both our free Facebook group as well as our tax minimization program. So if you have not joined our free Facebook group yet, join now. It's just go to Facebook, type in Small Business Tax Secrets, answer a few questions, and it will pop up, as well as our tax minimization program. This is our back-end program where we deep dive into tax strategies. Our goal with this is just to make sure and ensure that you're paying the least amount in taxes as legally possible. As part of it, we have library of tax strategies, implementation guides, downloads, videos going through them. We also do a monthly group training, and you also have unlimited access to our team for those general tax and accounting questions. So we're that partner on your team to kind of walk you through this journey. You can join that at taxsavingspodcast.com/tax. Now, if you haven't checked out our first article, What is Ordinary Income Tax versus Capital Gain Tax? Check that out now because we're going to be talking about that here, as well as we also did our first episode on earned income. Today, we're going to be talking about passive income, and next week, we're going to be talking about portfolio income. So let's get started. What is passive income? Now, per the IRS, passive activities include trade or business activities in which you do not materially participate. You materially participate in an activity if you are involved in the operation of the activity on a regular, continuous, and substantial basis. Now, they also mention that in general, rental activities, including rental real estate activities, are also passive activities, even if you do materially participate. However, rental real estate activities in which you are a real estate professional are not considered passive activities. So basically what passive income is, it's activities that would continue to generate income if you decided to simply sit on a beach and do nothing. Or in my dream scenario, golf all day, every day, and do no work. So think of things like rental properties or businesses where you do not materially participate in the actual day-to-day operations of. So that's what passive income is. Now let's talk about how passive income is taxed. This one's pretty easy. Passive income is not subject to FICA or self-employment taxes, but it is still subject to ordinary income taxes. So as we kind of talked about in our first article, What is an Ordinary Income Tax versus Capital Gain? Your ordinary income taxes are just your normal income tax rates using the tax brackets, ranging anywhere from 10% to 37%. So passive income is only taxed at your ordinary income tax rates. If you don't know what that is, definitely check out our first episode. Now, if you sell interest in a passive activity, example, let's say you sell a rental property, you will be subject to a capital gain or loss. Again, in that initial episode we talked about how capital gain or losses are taxed and what is a capital gain or loss. So be sure to check that out. And one final thing for passive income, for those of you with significant income, you may be subject to the net investment income tax. This would be an additional 3.8% depending on your income. And usually this is around $200,000 if you're single, $250,000 if you're married. So what is the good thing about passive income? Let's start with the obvious one. You make money without doing any significant work. What gets better than that? So once we get past that one, second, the money you make from that, you avoid FICA, which is Social Security and Medicare, as well as self-employment taxes on. And then the third piece, and this is one that we will dig even deeper on into our rental property series that we're going to be doing in the next coming weeks. But if you look at real estate specifically, you would typically have heavy depreciation in the early years of having that real estate. So you still may be cash flowing, but because of the depreciation, it's going to offset that actual income, and thus you're not going to have to pay taxes on the money you are making on it. Let's use an example. Let's say you buy a $300,000 investment property, a rental property. You might invest, or you might depreciate 150 of that in the first year. Maybe use a cost like study or something like that. But let's just use an example. You deduct 150 in depreciation in year one. Well, you're going to be taking it, you're going to be making cash on the rents in year one, but it's not going to be that high. So you're going to be able to offset it with that depreciation. Same thing in year two and year three. That depreciation that you have from the early onsets of a rental property is going to offset any income that you're actually making. So you're still cash flowing, you're just not paying tax on it. Now, fourth, as with self-employed and business income, you can also take advantage of the tax code with passive income. You can take deductions or write-offs against your income, and that's going to help reduce the taxable amount of it. So if you have a rental property, you can hire your kids in your rental property. You're going to have utilities. You're going to have maintenance. There's going to be expenses that you can utilize to offset some of that rental income that you have from the passive activity. Now, one thing to note is that oftentimes earned income that we talked about last week can eventually turn into passive income. So let's say you're a business professional and you're building out an online course to teach what you're doing. During the development of that course and that initial growing of the course, it will very likely be considered earned income because you're heavily involved. You're actively participating in that activity. However, you may eventually get to a point where it runs without you, because you've already created the content for it, you have a team around you that supports it, and this will then allow you to step away from the business. At that time, you may have earned income that got turned into passive income. Finally, one thing to note is that passive losses can offset other passive income. So let's imagine that you have a new rental property that has heavy depreciation in year one that you're not going to utilize, but you also have an older rental property that is maybe fully depreciated, and you're just simply earning that passive income on it. You can utilize the passive losses from the heavy year one depreciation from the new rental property that you have to offset your passive income from your older rental property. And we're going to be doing a full series on this future on rental activity and how that all plays into this activity, but this is just kind of the primer to understanding what passive income is. Now, here's a key thing. What are passive activity loss rules? And this is really the biggest downfall to passive activity, is this idea of passive activity loss rules. So as we talked about above, oftentimes passive activities can produce large losses in their early years because we have heavy depreciation coming in, and that could typically be used to offset other income. However, passive losses can only offset other passive income. We talked about that before. You cannot use a passive loss to offset earned income, capital gains, or portfolio income. So essentially, if you have a rental property that's passive and you have a loss on it due to high depreciation, you can only offset that loss against other passive income, which would be rental activity or businesses that you do not actively participate in. But you cannot use that loss to offset earned income, W-2 income, or capital gains. So this can be frustrating for many. Now, with that being said, there are some exceptions and workarounds to this that we're going to be discussing in our real estate series on how can we turn passive income into earned income to be able to take advantage of that potential loss coming from it. All right, so let's go through just a little summary of passive income. Passive income is taxed at your ordinary income tax rates. These are just going to be your normal, typical, marginal tax rates. Passive income is not subject to FICA or self-employment taxes. Passive activity is income sources in which you do not actively participate in. Think of things like real estate again. Think of things like a business that you're maybe just a silent investor in. You're not actively participating in the day-to-day. If you sell your interest in a passive activity, that will create a capital gain or loss. Passive activity includes most real estate unless you're a real estate professional. And passive losses can offset other passive income. However, passive losses cannot offset earned income, capital gains, or portfolio income. And finally, an activity could potentially start out as earned income that we talked about last week, but eventually move into passive income. So that's kind of the summary for passive income. Be sure to check out our other episodes on how is my income taxed. Just as a reminder, we talked about ordinary income tax versus capital gain tax. That was our initial episode that kind of brought this idea of the different types of tax. And now we're deep diving into different types of income. We talked about earned income. That's going to be your W-2 type income and how that is taxed. Today, we talked about passive income. That's going to be your real estate and not activities that you're not materially participating in and how that is taxed. And then next week, we're going to be talking about portfolio portfolio income and how that's going to be taxed. So these all play together. All these episodes kind of play together, and it's really going to be a framework of how we look at the different buckets or different types of income that you can receive and how it gets taxed and how we can utilize that knowledge to make sure we're paying the least amount of taxes as legally possible. A couple housekeeping notes. Reminder, we have our Small Business Tax Savings Summit coming up next week. So it's going to be June 14th and 15th. This is a 2-day event. Whether you're just getting started in business or you've been in business for a while, you're going to walk away rejuvenated with ideas to make sure that you're paying the least amount of taxes as legally possible. So you can check this out at taxsavingspodcast.com/summit. Again, this is June 14th and 15th. And finally, if you are not yet a member of our tax minimization program, take the time now to check it out. Go to taxsavingspodcast.com/tax. Within that program, we go through a bunch of tax strategies, and the main goal of that program is to ensure that every single year you're paying the least amount of taxes as legally possible. We teach you tax strategies. We have videos. We have downloads. We have various different templates to utilize. We do a monthly group training where we deep dive on topics. And best part is you have unlimited access to our team to ask us email questions regarding tax and accounting issues that pop up. So feel free to check that out. Again, that's taxsavingspodcast.com/tax. Again, next week we're going to be finishing up our How is My Income Tax series with portfolio income. If you have not checked out our initial episodes, what is ordinary income tax versus capital gain tax, earned income, definitely check those out as well. And I will see everybody next week. Thank you for listening to another episode.
This has been another episode of the Small Business Tax Savings Podcast. If you enjoy our weekly episodes, please leave a review and share with other business owners. You can find previous episodes and more information at www.taxsavingspodcast.com. Thanks for listening and have a great day.